All right, let's talk about the benefits of opportunity zones. Why even do an opportunity zone transaction? What's in it for me, right? And the real answer is threefold. So first, when you invest into an opportunity zone transaction, you get a temporary deferral on the capital gains that you would otherwise normally have to pay taxes on the following year. And so if you defer into a qualified opportunity fund within 180 days or 180 days of the end of the partnership tax year, if it's in a partnership or an S corporation, then your taxes are deferred until the sale of the new investment or December 31st, 2026, whichever comes first. So don't discount that deferral because effectively what it is it's an interest-free loan from the government for what you would normally be paying in taxes, which can be substantial. The second is that if you were invested for 5 years before December 31st of 2026, then when you pay the taxes in April of 2027, based upon the value of them as of December 31st, 2026, then you're going to get a 10% step up in basis. And what that effectively means is a 10% reduction. And I'm going to go through the math in the next slide, but that's the second benefit is a step up in basis, which basically functions like a reduction in your taxes. The third, and I think the biggest benefit, is the permanent exclusion. It's a step up in basis to fair market value after you've held your interest in the qualified opportunity fund for 10 years. So you don't have to hold an individual asset for 10 years. The assets only have to be capital assets. But at any point in time after a 10-year hold and prior to December 31st of 2047, when you sell a capital asset or your qualified opportunity fund interest or a qualified opportunity zone business interest, you get a step up in basis to fair market value, which means that you not only pay no capital gains, but you also will not pay depreciation recapture on the gains of your new investment. And don't discount the significance of that, because effectively what it could allow you to do is to basically take all of the income on your new investment tax-free by writing that off against the depreciation and then ultimately selling that after a 10-year old and not paying any taxes at all. So let's run the math on this. This is $1 million invested that's $1 million of capital gain that's reinvested in 2020. And we're assuming that it's going to double in value by 2030. So on the side, the left side over here, this is a QOZ transaction and this is a conventional investment. And so if you are investing into the opportunity zone, the first thing is that you get to invest the full $1 million as opposed to 762,000 because you're paying 238K in taxes in April of 2021. So once again, don't discount that loan, that interest-free loan from the government that you now get to invest in a vehicle that's ultimately going to come back to you tax-free. So you're also going to be invested prior to December 31st of 2021. So you're going to get the 10% reduction in cap gains when you go to pay the taxes in 2027. So in 2027, those taxes due are going to be $214,200 instead of the $238K that you would have paid in 2021. So you got a time value of money thing going and you got a reduction that you're going to have to pay. Then, and this is where the real math gets, this is where the real juice comes in this program and the math gets really interesting, is that after year 10, you're going to get a $1.785 million payout versus a $1.161 million payout over here. And so you can see, and this IRR is a little bit low because it's 10%, it's over 10 years, but it's almost 2% above what this one is. And that's just assuming that you double your investment. This also doesn't factor in the depreciation recapture exclusion, which if you have depreciation in a deal, which you're probably going to have, you would get to take as well. So this is real money, right? Because it's 53.8% greater, right? An additional $624,512 greater, which is, I'd say, really robust. and justifies, going through the rigmarole of the setting this up, learning about it, and then ultimately doing the compliance along the way.